Greetings, it is time for another monetary creation update, and we go to our familiar Yardeni report all the way down to this chart over here, figure 15. This is the cumulative balance of the four major central banks of the world that comprise about 85 to 90% of the entire world's money printing. The US Federal Reserve is in green, the European Central Bank is blue, Japan and China after that. And as we can see, the US and Europe are deprinting a fair amount of their money, but the US is still just a little more than 1/4 of the entire world's money printing. That's why online when you see a lot of screaming about how the US Federal Reserve has printed a lot of money and therefore the price of something that is priced worldwide, like gold, should go up, that is very, very inaccurate because it presumes that the US is the only country in the world and certainly the only country printing money. Nothing could be further from the truth. At its highest point, Europe had done much more than the US. But since money printing, monetary creation is worldwide, and technological deflation is also worldwide, only the worldwide total matters. So to see that, we go up one chart to this blue line up here, which is the sum of those four charts we just saw a second ago. The red line is the one that excludes China because the China data is delayed by about a month. The blue chart is closest to the worldwide total. And as we can see from the highest point in early 2022, it has come down a little bit, but it's still way more than it was before COVID, which itself is way more than it was in 2008, 2009 when quantitative easing began. So some people might say that quantitative easing has been reversed and it's over, but that is absolutely not correct. It is below its all-time peak of 30 trillion, but it is still at about 25.3 trillion, as you can see over here, which is more than it ever was at any point until mid-2020, and certainly higher than the pre-COVID amount. So this total trend is definitely still upward in terms of money printing needing to be exponential in order to offset technological deflation and the money gap, as per Third Millennium Economics and my thesis about that. However, there is one curious thing that is occurring, and this I don't have a good explanation for because we don't have much data for it yet. This slight decline in money printing, again, not enough to truly break this trend, but this slight decline has not been matched with a correction in the stock market, the S&P 500, when in fact the two previously were very closely correlated. So let me examine that. Over here, this red line is the summation of the central bank money printing that we just saw a minute ago, and the trend of movement is what we're looking at over here. So the fact that this red line excludes China doesn't really matter over here because of the close correlation that we just saw. And this blue line is the S&P 500, which is about 98% of the US stock market capitalization. And traditionally, you would see that the stock market would rise when central bank balance sheets, cumulative money printing, was rising, and the stock market would ebb when the balance sheet was unwinding briefly, only to rise again when they had to print more money. But now, for the first time, only for the last year or so, the stock market continues to rise despite this unwinding of the balance sheet. That's only been true for the last year. Prior to the last year, for another 14 years, these two things were very closely correlated. Why is that? Is the stock market going to fall, which means it would have to fall from the current level of S&P 500 down to maybe 3,800, or is something else going on? There's another curious aberration here. The stock market is usually very correlated to the amount of M2 money supply, and M2 money supply has been rising even amidst this central bank unwinding. So we're going to go to another chart for that. This is the Federal Reserve M2 money supply. The link for this will be in the description box below. And it has always been rising on a steady exponential trend until COVID required a huge amount of money printing that boosted this up, and now it's returning back to this trend. But as we go to this 5-year chart, you can see the pre-COVID amount, COVID boost, and then moderation. This stopped going down, so even though the deprinting would lead us to think that money printing should be down around here, a couple trillion less than where it is, somehow this is still rising amidst that balance sheet unwinding, which is a mystery because these two things have always been correlated. Now, I spoke about this several months ago. In this video up here in the right hand corner, about how maybe they're doing a secret type of money printing that is not on the balance sheet because they want to make sure the economy is strong going into the US presidential election, but they don't want people to notice, and that's why they are printing in a manner that is off balance sheet. That would explain the stock market not falling, because the stock market continues to be correlated to M2, but M2 seems to be rising even as the balance sheet is falling. What could the reason for that be? This is the 1-year chart of M2, and now it's rising. Why is it rising only since October of 2023? It was falling as predicted with the decline in balance sheet, but now it is rising. Why might that be? Is it secret printing, or is the technological boom in AI creating so much momentum that money is piling in from other sources which it would not normally come from, and therefore it's very temporary? That remains to be seen. A third theory that I've put forth is that technology eventually can become independent of needing central bank liquidity because it can produce its own liquidity and money. Much like how if you take a bird or reptile that is an embryo in an egg, it has to be in the egg for a certain amount of time until it can hatch out of the egg and then survive independently of that egg. Now that theory is still only a theory. I don't have enough data to put that forth quite yet. I did not expect technology to get to that type of a point until the 2030s or later. So if it's happening this soon, that is actually a very positive thing in terms of human upliftment through technology. But this third possibility is very much a theory, and I'm just going to look at the data before I say that is in fact what's happening, because the stock market could correct in a few months' time, and then this correlation would be rematched. And they will resume money printing after that because they cannot withstand a major stock market fall, even if it is from an all-time high and to a level that used to be a record high just a couple years prior. That is the nature of our entire fiscal, monetary, and governance system. Now, the correlation between money printing and inflation is often the second part of this video. So now we go to part 2, which is my inflation update. And as always, with my monthly inflation update, I go to my familiar matrix, where I say that there are 3 holistic, comprehensive, non-volatile, because they're longer term, measurements of inflation, and all 3 of these have to be above 3% before I say inflation is structurally high, and inflation too far below 3% is also a negative because we are veering too close to deflation. Deflation is much worse than moderately high inflation, as I explain in this tag in this upper right hand corner up here. So the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. All 3 of these have to be above 3% before I say inflation is structurally high. And again, 3% would be optimal. It's not some big red line of a speed limit. 3% would be optimal. 3.1% would be very, very slightly above optimal. But proportionality above 3% for all 3 is what would be high inflation if that were to happen, and that has not happened in a very, very long time. So let's go to the 10-year US Treasury yield first. 10-year US Treasury yield, 4.213%. If I take the 5-year chart, you can see it's risen, but it can't get really too far above this 4% threshold, although this is considerably above 3%. So this is 4.213%. It's not so much a measurement of past inflation, but it does affect mortgage prices and loan payments for any other type of loan as well, including car loans and student loans. Now we go to the Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, 10-year compound annual growth rate is still minus 1.37%. It is in deflation. It is nowhere near plus 3%. It is minus 1.37%. And this is the most important of the 3 measurements, as I say each month, because commodities are the purest, indisputable cost that worsens human living standards. Service price inflation is more ambiguous because a rise in service prices is simultaneous with wage increases for the service provider. If a haircut that used to be $10 is now $20, yes, the customer of the haircut is paying twice as much as several years ago, but the haircut provider, the barber, the hairdresser, is making more as well. It's very simultaneous. So commodity prices not having a labor component to any significant percentage, which makes them a commodity, is the more indisputable case where lower prices are good, higher prices are bad. When oil prices are high, only a small number of countries, which are usually bad actors, are making a lot of money, and the rest of the world is paying too much. When oil prices are low, the rest of the world is paying less, and the oil exporters, many of whom are bad actors, are making much less and cannot get away with as much negative behavior. So Goldman Sachs Commodity Index is minus 1.37%. Now we go to the US CPI. This is the bls.gov website, which you'll see in the description box below, along with all associated links for this video. And this is the US CPI in its most recent reading. And to take the 10-year inflation rate, we take this reading, the most recent one, 313, and the reading exactly 10 years prior, 237. The difference between the two is the 10-year amount of inflation, and then dividing that into 10th roots will tell you what the average compound annual growth rate over this 10-year period was. And right after this, I'll have a table that shows you more about that. And we can see the various windows of inflation snapshots to get a comprehensive annualization. 1 month, 2 month, 3 month, 6 month, and 12 month. Yes, there was that inflation spike for about 1 year in late 2021, early 2022. That is now in the past, and how long are people going to keep whining about that? Yes, this plateau is higher than it was before, but it's still at about the 3% level. But we take the 10-year compound annual growth rate, and we shall see that in this table over here. This is the same CPI data summarized in an easy-to-understand table. The 1 month reading was 0%, so the annualized CPI gain for the last 1 month's reading was 0%. 2 months, you have to take the 6th power of that, because there are 6 intervals of 2 months each in a year, factor to annualize. The 3-month window, you have to take the 4th power to that. 6-month window, you have to take the square of that. 1 year straight is 3.3%. There are a lot of people who say only the 1 year window matters, but they only say that when it's high. When it's not high, then those people are nowhere to be found. We have seen comments by such people many times before. They don't seem to be very good at arithmetic. And then the 2 year window, to get the annualized inflation rate over that, you take the square root of it, because over 2 years there was 6.1% inflation, which means per year that's 3% a year. Over 3 years there was 15.5% inflation. That means per year that was 4.9%, the cube root of it. 5 years, 5th root, and 10 years, the one we're interested in, 10th root. In 10 years, there was 32.1% CPI inflation in the US. That is 2.8% a year. And then just for another reference, I include the entirety of the 21st century. Since January 1st, 2001, there has been 78.9% inflation, which is 2.5% a year. So this is the number we are interested in for my matrix. It is still at 2.8%. It is not at 3%. And these recent months are also below 3%. The last 3 months has annualized to 2.8%. So these little blips are receding away into the past. And only in the 3-year and 5-year window do you see that one big 2021, 2022 spike in inflation, which vanished as quickly as it arose. And even that does not move this 10-year inflation rate higher than 3%. It's still at 2.8%, even inclusive of that big spike. So we go back to my matrix. So we saw all three measurements: 10-year compound annual growth rate of the US CPI, 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And today, June 16, 2024, the results, as we saw, were 2.8% for the CPI, so still below 3%, minus 1.37% for the Goldman Sachs Commodity Index, which is still the most comprehensive index because it is worldwide and it's not riggable. There's always someone who says, well, everybody knows that inflation data is rigged. No, it is not, because the Goldman Sachs Commodity Index is comprised of freely traded commodities. I know you memorized a statement that inflation data is rigged, but this clearly proves that it isn't. Stop memorizing falsehoods just so you can feel like a victim. 10-year US Treasury yield, this is the only one that is above 3%. But since only one of these three is above 3%, structurally inflation is not high. In fact, the Goldman Sachs Commodity Index is continuing to show how technology has crushed the commodity complex entirely. So no, inflation is not high. I don't care what anyone says, because I have shown multiple varieties of data, And the people who want to pretend that inflation is high, they usually only give the weakest and most ridiculous of anecdotes. To study why they are wrong, see this video up here in the upper right hand corner, Kartik's Law of Inflation, where I present the 7 most common types of very, very unscientific, very emotional arguments that people give in order to pretend that inflation is high because they have a need to believe that they are being victimized so that they can excuse themselves from personal responsibility. Now, in the final part of this video, I want to show you a chart about the velocity of money, because many people say that when that rises back up to what it was pre-COVID, then there will be high inflation, and I will show you why that is not the case. This is the velocity of money chart from the Federal Reserve, Fred. The link for this is also in the description box below. And you can see this long-term velocity of money, and yes, it has been going down over the course of quantitative easing, but what happened over here during COVID-19? So for this, we get to the shorter 10-year chart window. The amount of money printing in COVID-19 was so much that it made velocity of money fall, and it stayed low for a while. And everyone said that when it gets back to what it was pre-COVID, that will cause a huge inflationary spike. That did not happen, because now we have gotten back to just about the same level. It's now 1.36, whereas before COVID it was 1.43. So there's very little more room for this theory to manifest in. A return to this level is no more runway left for this supposed inflation spike. People are pulling out any type of rationale to justify why an inflation spike will occur, but then these are the same people who say that inflation is already high, so they are contradicting themselves there. But if you ever hear that point about velocity of money being low is the only reason inflation is not higher, and when it gets higher, then inflation will be high, well, that has already happened, and we did not see high inflation. In fact, the time we saw that one-year inflation spike was over here, perhaps in expectation of this increase, but now that is also in the past, so it is over. Velocity of money can no longer be a factor contributing to aberrantly high inflation. So this was my inflation update as well, and I hope you found this video to be informative, and it helps you cut through the false scare memes that the media wants to foist upon you. So if you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching.